Most people believe that a financial crash is an event. They think it looks like a single day of panic. They imagine traders screaming on the floor of the New York Stock Exchange, red arrows flashing on cable news, and banks locking their doors. They are waiting for a black swan, something unpredictable and sudden. But they are wrong. The next collapse will not be an event. It will be a process, and it will not be unpredictable. In fact, it is already scheduled. There is a specific date on the calendar that keeps central bankers and hedge fund managers awake at night. It is not this year. It is not next year. It is the year 2027. Why 2027? Because that is the year the bill comes due. To understand the 2027 trap, you have to understand the concept of a maturity wall. When corporations and governments borrow money, they do not usually pay it back. They roll it over. They issue new debt to pay off the old debt. This works perfectly fine as long as interest rates stay low and the economy keeps growing. In 2020 and 2021, during the global pandemic, the world went on the biggest borrowing binge in human history. Corporations, realizing that interest rates were at 0%, locked in trillions of dollars of cheap debt. They issued bonds with 5-year and 7-year maturities. Now, do the math. 5 years from 2022 is 2027. In 2027, a tsunami of corporate and sovereign debt is going to mature simultaneously. Trillions of dollars of loans that were taken out at 2% interest will need to be refinanced. But in 2027, they will not be refinancing at 2%. They will be refinancing at 5%, 6%, or even 8%. This is the refinancing wall. It is a mathematical dead end. When this wall is hit, the interest expenses for the global economy will double or triple overnight. Companies that are profitable today will become insolvent tomorrow. Governments that are struggling to pay interest today will face a sovereign debt crisis. This is not a prediction. This is a schedule. The bonds have already been sold. The maturity dates are printed on the contracts. The trap is already set. In this video, we are going to document the silent forces that are building toward this moment. We are going to look at the 3 specific sectors: commercial real estate, private credit, and sovereign debt that are currently deteriorating in the shadows. And we are going to explain why the soft landing narrative you hear in the media is a mathematical impossibility designed to keep you calm until the trap snaps shut. We must begin by looking at the first domino, which has already started to wobble. Commercial real estate. You have heard the headlines about empty office buildings, but the media frames this as a work-from-home problem. They say that because people are working on Zoom, office buildings are worth less. That is true, but it is a massive oversimplification. The real problem is not the empty desks. It is the debt attached to the buildings. Commercial real estate is an asset class built almost entirely on leverage. A developer buys a skyscraper for $100 million. They put down $20 million of their own money and borrow $80 million from a bank. Usually, these loans are interest-only for a period of 5 to 10 years. At the end of the term, there is a massive balloon payment. The developer has to pay back the full $80 million. But they do not have $80 million in cash. So they go to the bank and get a new loan to pay off the old one. This is standard practice. It is how the industry has worked for 50 years. But in 2027, the game changes. Right now, there is approximately $1.5 trillion in commercial real estate debt that will mature before the end of 2027. These loans were originated when rates were near zero. The buildings were valued based on those low rates. Today, 2 things have happened. First, the income from these buildings has dropped because of vacancies. Second, the cost of borrowing has tripled. When these developers go to the bank in 2027 to refinance their $80 million loan, the bank is going to run the numbers. The bank will say, "I am sorry. Based on your current income and the new 7% interest rate, we cannot lend you $80 million. We can only lend you $50 million. The developer is now in a trap. They owe $80 million. They can only borrow $50 million. They have a $30 million hole. They have to come up with $30 million in cash immediately to close the gap. Most developers do not have that kind of cash. So, they have two choices. They can hand the keys back to the bank and walk away, or they can sell the building. But if they try to sell the building, who is buying? Everyone else is in the same trap. There are no buyers. So, the price collapses. We are already seeing this. In San Francisco, in Los Angeles, in New York, office towers are selling for 40%, 50%, sometimes 60% less than they were worth in 2019. This is the silent crash. It is silent because these transactions happen in private. They are not ticker symbols scrolling on the bottom of your TV screen, but the wealth destruction is real. And here is why this matters to you. Even if you do not own an office building, who holds the loans? The banks, specifically the regional banks. Small and mid-sized banks hold nearly 70% of all commercial real estate loans in the United States. When the developers default in 2027, the banks take the loss. If the losses are big enough, the banks fail. We saw a preview of this in 2023 with Silicon Valley Bank and First Republic. That was a tremor. The earthquake is scheduled for 2027, but commercial real estate is just the fuse. The explosive is the corporate debt market. During the era of free money, thousands of companies became zombies. A zombie company is a business that does not make enough profit to pay the interest on its debts. It only survives by borrowing more money to pay the interest on the old money. It is a Ponzi scheme, but it is legal. As long as interest rates were zero, these zombies could stay alive. They could borrow at 2%, pay their bills, and keep their employees. But in 2027, the corporate bonds issued by these zombies come due. There's a concept in finance called the high-yield maturity wall. If you look at a chart of when corporate junk bonds mature, the chart is relatively flat for 2024 and 2025. But in 2026 and 2027, the chart goes vertical. Hundreds of billions of dollars in junk debt needs to be refinanced. When a zombie company that is barely surviving at 3% interest tries to refinance at 8% interest, it dies. It is simple math. The interest payments will exceed their revenue. This means that starting in roughly 18 to 24 months, we are going to see a wave of corporate bankruptcies. These bankruptcies will lead to layoffs. The unemployment rate will rise. Consumption will fall, and the economy will enter a recession. This is the cycle. It is mechanical. It is unavoidable. But the most dangerous part of the 2027 trap is not the corporations. It is the governments. The sovereign debt trap is the ultimate endgame. The United States government is currently adding $1 trillion to the national debt every 100 days. The total debt is approaching $36 trillion. But the scarier number is the interest expense. The U.S. government is now paying over $1 trillion a year just in interest to bondholders. That is more than the defense budget. It is more than Medicare. And just like the corporations, the U.S. government has a maturity problem. The U.S. Treasury did not lock in long-term rates when they were low. They issued a lot of short-term debt. This means the U.S. government is constantly rolling over its debt at the new, higher interest rates. By 2027, the weighted average interest rate on the entire U.S. national debt will have moved significantly higher. This creates a fiscal doom loop. The government has to borrow money to pay the interest on the money it already borrowed. This new borrowing increases the total debt, which increases the interest payments next year, which requires even more borrowing. In 2027, this loop accelerates. The bond market, the people who lend money to the government, will look at this math and realize that the U.S. government is technically insolvent. When bond vigilantes realize that a government cannot pay its bills, they stop lending. Or they demand a much higher interest rate to compensate for the risk. If the interest rate on U.S. Treasury bonds spikes to 6% or 7%, the entire global financial system breaks. The US government would have to print trillions of dollars just to keep the lights on. This leads us to the three possible outcomes of the 2027 trap. History tells us there are only three ways out of a debt trap of this magnitude. Option number 1, austerity and default. The government could admit it is broke. It could cut spending by 40%. It could slash Social Security, eliminate the military budget, and raise taxes on everyone. This would stop the debt from growing, but it would cause a Great Depression that would make 1929 look like a picnic. No politician will ever choose this. It's a total no-go for any politician. Option number 2, hyperinflation. The government keeps spending. The Federal Reserve prints the money to pay the bills. They print enough money to pay off all the nominal debt. The result is that the debt is paid, but the dollar becomes worthless. A loaf of bread costs $50. Your life savings are wiped out, not because the money disappeared, but because the money has no purchasing power. This is the path of least resistance for politicians, but it destroys society. Option number 3, financial repression. This is the trap we are talking about. This is the most likely scenario for 2027. Financial repression is a subtle form of theft. It is a set of policies designed to force you to lend money to the government at a rate lower than inflation. Here is how it works. The government creates rules that force banks, pension funds, and insurance companies to buy government bonds. They might say, for safety reasons, every pension fund must hold 60% of its assets in U.S. Treasuries. This creates artificial demand for the debt. It allows the government to borrow money at 4%, even if inflation is running at 6% or 7%. If you earn 4% on your bond, but inflation is 7%, you are losing 3% of your wealth every year. The government is effectively taxing your wealth by 3% a year to pay off its debts. You do not see a tax bill. You just see that your standard of living is slowly declining. You are working harder, but you feel poorer. This is the boiling frog scenario. And it is the strategy that the Western world is adopting. Why is 2027 the breaking point for this? Because of demographics. By 2027, the last of the baby boomer generation will have reached retirement age. The strain on the Social Security and Medicare systems will hit its peak velocity. The government will need more cash than ever before, at the exact moment the refinancing wall hits the corporate sector. So, what are the silent signals you need to watch for? What are the indicators that the media is hiding? Signal number 1, the rise of private credit. As banks pull back from lending because of their real estate losses, a new industry has exploded. Private credit. These are non-bank lenders' hedge funds, private equity firms that are lending directly to companies. This market has grown to nearly $2 trillion. It is unregulated, it is opaque. No one knows exactly how bad the loans are. In 2027, when the corporate refinancing wall hits, the private credit industry will face its first real test. If these loans go bad, there is no government insurance for them. The losses will be total. Watch the headlines for gating in private credit funds, meaning they stop investors from taking their money out. That is the first sign of the crash. Signal number 2, the reverse repo market. For the last 2 years, the U.S. financial system has been kept alive by a pool of excess cash sitting at the Federal Reserve, known as the reverse repo facility. The government has been draining this pool to fund its spending. By the calculations of many liquidity experts, this pool will run dry sometime in late 2025 or early 2026. When that liquidity buffer is gone, the market will suddenly feel the true weight of the government's borrowing. Interest rates will become much more volatile. Watch the RRP balance. When it hits 0, the clock starts ticking for the next liquidity crisis. Signal number 3, central bank gold buying. We have discussed this in previous videos, but it is the most important signal of all. Central banks around the world, specifically in the East, are buying gold at a record pace. Why? Because they see the 2027 math. They know the US and Europe will have to choose between default and inflation. They are preparing for a reset of the monetary system. They are exiting the dollar and entering hard assets. If the people who run the global monetary system are buying gold, you should pay attention to what they are afraid of. So, how does the crash of 2027 actually start? It will likely start in the shadow banking system. It will start with a hedge fund, or a private equity firm that is highly leveraged in commercial real estate or corporate junk bonds. They will miss a margin call. They will be forced to sell assets to raise cash. But because the market is illiquid, their selling will crash the price. This will force other funds to sell. The panic will spread to the regional banks. Depositors will realize their bank is exposed to the crashing assets. They will pull their money. Then, the contagion will hit the sovereign bond market. Investors will sell treasuries, demanding cash. Yields will spike. The Federal Reserve will have to make a choice. Do they let the system collapse to cleanse the debt? Or do they print trillions of dollars to bail everyone out, triggering a second wave of massive inflation? History tells us they will print. They always print. This means that the crash of 2027 will likely not be a deflationary crash like 1929, where prices fell. It will be an inflationary crash like the 1970s or Weimar Germany. In an inflationary crash, the price of stocks might actually go up in nominal terms. The price of your house might go up, but the price of bread, gas, and energy will go up much faster. You will have more dollars, but you will be poorer. This brings us to the most important part of this analysis: preparation. If the trap is set for 2027, that gives you a window of time. You have roughly 24 to 36 months to position yourself. Most people will do nothing. They will trust the soft landing narrative. They will keep their money in a 60-40 portfolio of stocks and bonds. They will stay in cash. When the trap snaps shut, they will be the ones paying for the bailout. Their savings will be inflated away. To survive the 2027 trap, you need to think differently. You need to align yourself with the forces of financial repression. If the government is going to debase the currency to pay off its debts, you do not want to be a creditor. You do not want to own the bonds that are being paid back in worthless money. You want to own the assets that the money is being printed to buy. Hard assets. This is the classic hedge. Gold, silver, energy, agricultural land. These are assets that cannot be printed. When the currency loses value, these assets reprice higher. They are your insurance policy against the devaluation of the dollar. Productive technology. In a world of labor shortages and high inflation, the only way for companies to survive is to become more efficient. They have to automate. Companies that produce productivity, AI, robotics, energy efficiency will be the only ones that can grow in real terms. Fixed-rate debt. This is the counterintuitive part. In an inflationary collapse, having debt can actually be a good thing, provided it is the right kind of debt. If you have a 30-year fixed-rate mortgage on a cash-flowing asset like a rental property at a low interest rate, inflation is your friend. Inflation makes the dollars you use to pay back the debt worth less, while the asset you own goes up in price. You are effectively shorting the dollar. The government is trying to inflate away its debt. You can ride their coattails and inflate away your debt too. Jurisdictional diversification. The trap is global, but it will not affect every country equally. The US, Europe, and Japan are at the epicenter of the debt crisis. Emerging markets with low debt-to-GDP ratios, or countries that are rich in commodities, may fare better. Having some of your wealth outside of the Western banking system reduces your exposure to the specific regulations and capital controls that will be implemented in 2027. The narrative of the soft landing is a sedating drug. It is designed to keep you invested in the system so that there is enough liquidity for the insiders to exit. They are selling to you. The insiders, the CEOs selling their own stock, the central banks buying gold. They are positioning for the refinancing wall. They know that 2027 is the mathematical limit of the current cycle. The period between now and 2027 is the twilight zone. It is a period where the economy looks okay on the surface. Unemployment might stay relatively low. The stock market might even hit new highs. But underneath, the foundation is rotting. The debt is compounding. The interest costs are eating the tax revenue. The commercial real estate vacancies are crystallizing into losses. Do not be fooled by the silence. The crash is not an event that happens by surprise. It is a controlled demolition that has already been scheduled. The year 2027 is the year the control is lost. If you understand this timeline, you stop looking for the crash on the news tonight. You stop reacting to daily volatility. You start preparing for the structural shift. You have time, but you do not have infinite time. The wall is approaching. If this analysis helped you see the timeline more clearly, please subscribe to the channel. We are dedicated to tracking the liquidity flows and the hidden data points that the mainstream media ignores. We do not sell fear, we sell foresight. In our next video, we are going to dive deep into the specific mechanism of yield curve control, the emergency tool the Federal Reserve will use when the bond market breaks, and exactly what that means for the price of Bitcoin and gold. You need to understand this mechanism, because it is the reset button they are going to press. Stay watching, stay prepared, and do not get caught in the trap.